Today, we're hanging out with Mike Stewart, and we're gonna review a new construction townhome with positive cash flow, including the HOA dues, that is brand new construction and is located in a townhome community, which JWB has significant influence that mitigates the risk for our clients. We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Property of the Week. I'm your host, Pablo Gonzalez. With me today is JWB's senior account manager. He has been there longer than anyone else as an account manager. He's been there 5 years. He is a self-described townhome groupie, comes from the Midwest, super knowledgeable, the beloved Mike Stewart, known as Stewie. Welcome to the show, Stu.
Hey, everybody. Thanks for letting me hang out.
Oh man, I'm happy to have you here hanging out while the fellas are doing their strategic business planning. I'm gonna need your wisdom because everybody knows I'm not an expert. I just play one on TV. I get to be guilty by association with experts like you. And I like to say, as we're welcoming the community, if you want to find out about how to own rental income properties, you have definitely come to the right place. If you want to find out about best practices for rental property investing as a property manager, you're in the right place. And if you're just trying to get an edge on the Jacksonville market that's red hot, as a real estate professional, find some new opportunities, you're in the right place. Next place to go after this is chatwithjwb.com. And the next place we go after that intro, Stewie, is the roll call. You didn't get this last time we were here. You ready for the roll call?
I don't think so. What do we do?
All right, here we go. It's just me roll calling everybody that checked in. So if you haven't checked in the chat, check in so I can say your name. Here we go. Leo, good morning all. Carl Thompson, good morning everybody from Chile, Colorado. Joanna's checking in. Good morning. She's our community manager. Make sure you say hi to her in the chat and ask her for anything you need. Jen fills in. The fairy godmother of the Not Your Average Investor Show community is here from Monterey, California. Drew Barnhill checking in from Hotlanta. He's here. Marilyn Cotterman from Homosassa, Florida. You know what Homosassa is known for, Mike?
I've heard there's manatees down that way.
It's the home of the manatees. You are correct. We got Nadeem Shah. Good afternoon, Nadeem. Good morning to you on the West Coast. Who else we got? We got John Henning in the house. Good afternoon, John Henning. I am looking through. We got Hervé Francois from New Jersey saying, "What up, fam?" Good to have you, Hervé. Michael Elnor is back. Michael, good to have you back. He says hello, everybody. He's a new member of our community. Gerald Freeney, that's a name I don't recognize. Gerald from Chicago, good to have you. I hope that you like what you hear and you keep joining us and become a member of this awesome community. And we got Ken Moline checking in. He is a former star of the show, star in real life all the time. Welcome, Ken, good to have you. And we got Jerry R from New Jersey checking in. Jerry, I'm gonna take a shot at your last name. Jerry Ramna Marine. Let me know how I did in the chat. That wasn't easy. Good to have you. Scott Belot's in the house. He's a shot. Oh, he says close enough. All right, cool. Thanks, Jerry. He's checking in. As you were going to learn, we got a really active community that joins us every single week, and we got new members that are joining us every week. This is a audience-driven show, specifically these Thursday properties of the week, because when we dive deep into, Lee Bishop is in the house, the MVP of the Not Your Average Investor Show community. Specifically these weeks, as we dive deep into a property, and you can download that property by going to jwbinventory.com. You're going to be able to download the sheet that we're looking at today. That's the first way that you want to participate. Get the sheet, fiddle with it. You can use it to structure any of your real estate deals. It's a really, really complete sheet. All right, that's the full intro, Stewie. You still with me, buddy?
Yeah, man. Breathe.
Stewie, before we get into this property, right, as people are going to jwbinventory.com to download this sheet, I would love to just, from your perspective, you've been there, you're the senior account manager. What is kind of like, what do you see happening in the market these days, and what's happening from your angles?
Yeah, I think, when we just look at big picture supply and demand, Pablo, it continues to be, very, very strong. We thought we'd get an opportunity to play a little catch up on the construction side specifically, but we're still seeing, significant demand to the point that, lead times are going to be a little farther out. So I think for most folks, when we look at the return profiles, we look at the interest rates, everything's held relatively steady at the moment. I think we'll see more as we get into the latter part of this year into Q1. With interest rates specifically, prices are continuing to push. I think we're going to see, above average home price appreciation as we pushed into next year, which, we've seen on a couple of different shows from a few different people. So really, I think the biggest thing is, for folks as they're looking at their portfolios, and potentially starting or potentially adding, just making sure that you plan and you've got adequate lead time, and you're getting after it earlier rather than later, right? Because you're going to be in a position where not only can you take advantage of interest rates and home price appreciation, but just from a sheer logistics standpoint, you're going to be in a really wonderful spot.
Awesome. Yeah, we keep seeing this like dynamic of the supply and demand curve favoring the investor that invests now, right? As things are continue to go up and you got that appreciation baked in. Shout out to Joanna who shared where you can download the property sheet in the chat. So if you haven't had the chance to go there, you can just one click, go there, download it. Stewie, I got two more questions for you. The next one is, Gregg talks about it all the time about how everybody else has a waiting list and JWB doesn't. When you were talking to folks that are interested in this asset class, are you hearing that since you're on the phones? Are people expecting a waiting list when they talk to you?
Yeah, I mean, I think when we look and kind of get a pulse on competitors, throughout the country, a lot of turnkey providers in the Midwest are still anywhere from 12 to 18 month waiting lists. And when you do have an opportunity to get a property, it's kind of vultures, right? All trying to grab the same one at the same time, and I think that is clearly not the preferred way to grow a portfolio, right? So I think if we were solely doing renovated properties, obviously we'd have the same challenges that everybody else would. But again, kind of the foresight and planning, on leadership, 10 years ago, as we were getting into this whole, build to rent concept, has really allowed us to thrive and be in a place today where we can help people start portfolios and continue to grow them here in Jax. Awesome, man. Awesome. And kind of dovetailing right into that. First of all, Gene Ferreter, welcome back. He's checking in. Gene Ferreter. Hey, Gene.
Dovetailing into that, I was, before you and me hopped on for this call, I was on a call with one of your team members, Kay, kind of planning the shows and the community and stuff. And I saw you in the background blowing a big old train whistle. You want to tell me what that train whistle was all about?
Well, the train whistle, actually, funny backstory before we talk about what it was used for today. So the train whistle was given to me. We did a presentation several years ago as we were implementing team-wide changes and really trying to lean into it. So I dubbed it the change train is what everybody was getting aboard. So everybody had a big time, right, and gave me my own whistle, which then has been used in all sorts of shenanigans at that point. But typically when we're celebrating something, right, if it's a birthday, if it's an anniversary, today our acquisitions team locked up a huge package of properties, which was really exciting, right, as we kind of look at planning for the future and inventory that we're going to have available for our clients. So we wanted to celebrate that, and I think you caught me mid-celebration.
I love it, man. I love the change train. So you guys locked up a package of properties. Is this a package of properties to property manage, or is this future inventory for turnkey investors?
Likely strategic assets and future inventory. So I think a combination of both is kind of what we're going to be looking at there with that. We'll see, right? I think everything can change, hence change train, but hopefully, it's going to be a solid mix of both that we can offer, to folks down the road.
I love the change train, man. I'm a big fan of anything that you can also then afterwards go like this and change train coming. All right. Yep. So we don't have a change train coming, but we got a property train coming. We're going to be magically whisking us away here too. Let me make sure all the settings are correct. Let me know in the chat if this thing comes in clear, but property train, we're headed off magically to 8490 McGirt's Village Lane, Jacksonville, Florida, 32210. Let me know in the chat that you can see it clearly. If not, I can mess around with it. You can also download this from the link that Joanna put in the chat or by going to jwbinventory.com. It is a purchase price of $177,000. You see in this picture here, okay, I'm hearing from Lee that it's a little blurry. Let's see what we can do to help that out. You see from the picture here, it's a beautiful new construction townhome, 3-bedroom, 2.5 bath, 1-car garage, leased at $1,224 a month, and it's got an estimated conventional financing total monthly cash flow of $112 and an estimated conventional financing total ROI of 7.4%. If you have any questions you want to start getting them answered, pop them in the Q&A. In the meantime, I'm going to ask Mike my own set of questions. Stewie, what do you like about this property, man? Is there anything in particular?
Yeah, I mean, I think our townhomes, like I was telling you before, we got on the show, I probably personally get more geeked out about townhomes than anybody on the team. When we have them available, we usually get them available. They'll come online, 3, 4, 5 times a year, just kind of depending on construction and as the buildings are being released. But I think, in general, townhomes, when you look at pound for pound, price per square foot, you're getting the most house for your money in the townhome situation. And especially when we look at median home prices breaking, $300,000 for the first time in Duval County here recently, right? The challenge to find homes, especially new construction, sub 200,000, right, is harder to do. And this is a wonderful solution for that. I think the big thing that a lot of people, almost a misconception is they hear townhome or they hear HOA. And I think we've been like genetically hardwired, coded to, just see that, tuck tail and run the other way, which I think fundamentally is a mistake. I think when you have a townhome like McGirt's Village, especially one that's very simple in terms of the HOA setup, that is going to be the determining factor as to whether it's going to be investor friendly or owner occupant friendly, right? And McGirt's checks all the boxes for a wonderful new construction home that's priced appropriately and an HOA that plays to the investor's favor.
Awesome. So tell me what you mean by most home for like, how'd you describe it? The most home for your money kind of thing. Are you talking about square footage? Or are you talking about rent?
Yeah, absolutely. If you look at, comparable single families, right? If we pulled this townhome out of the building, made it a single family in that same section of town, easily it's probably 220,000, I would guess, in that ballpark, right? For a 1,300 square feet. So if we can take it, even though it's in a shared setting, right, it allows us to, build in a much more cost-effective fashion and offer it at price points that are very attractive, not only to potential investors, but also you have to think about it on the resident side, right? You've got kind of a group of folks that are, more in the market from a budget perspective to rent an apartment. You've got a group of folks that are in the budget to rent a bigger single family home, right? And then there's this big crevasse in between. So making sure we have options in terms of affordability, not only for investors, but also for residents. This is beautiful. It bridges the gap perfectly. And that's why as a company, right, we're focused on delivering more of this, especially as Jacksonville continues to grow and affordability becomes more of an issue long-term.
Got it. Okay. So that makes a lot of sense. That's a great description. You also said something else along the lines of, we've all been taught that HOAs are bad and HOAs aren't all that bad. You want to kind of explain to me how you think about HOAs?
Yeah, I think when you hear HOAs, right, the alarm goes off a little bit. You think about special assessments, you think about things that I have to take care of in the future, right? So if you go to an HOA where you've got an Olympic-sized swimming pool, you've got tennis courts, an amenity center, this, that, and the other. Clearly, that's a wonderful benefit for an owner occupant, right? If somebody's, buying that home to live there, you want those features. But as an investor, that's a potential impact to cash flow and ROI at some point down the road, because guess what? That amenity center, that pool, that tennis court, at some point it won't be cool anymore, and we need to make it cool again, and it costs a lot of money to go do that, right? So that's why I think oftentimes when you're looking at even single families with an HOA or townhomes with an HOA, we're just trained to say that's bad, right? But I think at the same token, if you intentionally seek out HOAs that are as simplistic as they can possibly be in a group setting, and HOAs where you have sizable representation and can kind of throw your weight around a little bit, then it goes from being, a detriment to, a potential benefit for you in terms of houses that you wouldn't have otherwise had access to. So when you look at McGirt's, for example, I mean, it's literally one street on the west side, a fantastic JWB story, right? The developer started it, couldn't finish after the financial crisis. We came in and bought the rest of the land, and and have built it to what it is. And we're getting to the point now, I think we've got another building or two left to finish it, and then it's going to be done, and it's beautiful. It looks wonderful, but you don't have that pool, you don't have that amenity center. I think they have a small playground for the kids. That's about it, right? The HOA's job is to make sure that we take care of exterior maintenance, we take care of landscaping, keep the place on the up and up, and then exit stage left, right? And that allows us to have that group setting that accomplishes what we're trying to do in terms of the aesthetics of the area, right? But also from a cost perspective, very, very friendly to the investors and even the owner occupants that live there.
Got it. So I'm hearing two things basically standing out. Number one is the less amenities that exist for the HOA, the less risk there is for the investor. There's less stuff that's going to then cost more down the line to take care of. And then two, it's this idea that if you can buy into an HOA that's dominated by a pool of people that have your same interest in mind, AKA a bunch of other JWB rental property investors, that also hedges against risk, right? That's kind of what you said there?
Absolutely. 1,000% spot on, Pablo. Mm-hmm.
Cool, man. Is there also, this is $1,000 a year, and I'm seeing this ROI here in this monthly cash flow. The HOA is also built into this final number over here, right? Like that's not an extra thing that you don't have to account for. You're already pricing the HOA into this return.
Absolutely. Absolutely. And if you click on that analysis, conventional finance, Pablo, if you go to that 4 tab over on the right, in the monthly column, if you can make that a smidge bigger, you'll see that we've already factored it into that projected monthly cash flow, that $85 a month. It's row 26. Yep. As you look at it. So when you're seeing that figure, right, it's already factored in, and then it's also factored in to go up, right? Because I don't think anybody expects an HOA to come to you and say, oh, guess what? It's a little cheaper to run the community this year, right? We know that those types of things are going to increase. So when we project, expenses rising, just like we would project taxes or insurance for you guys, we've got a 3% growth rate built in as well. So I think oftentimes when they look at it, they think, well, ROI is this, and then I've got to net out the HOA and I'm going to be lower. It couldn't be farther from the truth. We've tried to get a couple steps ahead of it.
Love it. All right. So that is available for anybody that's downloading the sheet. You can see it for yourself. It'll bake it into whatever other numbers you put in there as well. We got a couple questions already rolling in, which I love. Keep the questions coming. This is awesome. We have somebody returning to the show. He's from France. Anonymous Attendé asks, thank you for the info you are sharing. Can you comment on the turn times now? I see some properties listed for rent for more than a month. Is there a glut of properties for rent?
Yeah, actually the opposite. So when you look at JWB properties, and you guys can, even go to jwbrentalhomes.com and pull it up at any point. I think when I looked the other day, we were in the 70s as far as houses available, right? So if we just do quick math on that, that's almost a 99% occupancy rate over the entire portfolio. So if we have over 4,000 homes, almost 4,100, and we've got 70, 80, 90 available, that's a very small percentage overall. And historically, to give you some perspective, turn times, when we talk about all of the metrics that we track, the big one on that side is what we call market to move in. So traditionally, from the point that a home is released to my leasing and marketing team to the point that we've taken an application and a deposit, and we're underwriting and physically moving somebody in, it's usually about 45 days. The last several quarters, it's pushed closer to 30, right? So when we try to prep folks at the end of the day, usually that 45 to 60 day kind of expectation setting is what history tells us. As of late, it's been a little faster.
All right, so that is not the opposite of a glut. It is moving quickly. Turns are getting filled. When I hear that as an investor, I think, okay, so next time that my tenant leaves, there's going to be less time vacant, ergo my long-term returns are going to be higher, right?
Yep, absolutely.
Love that. All right, Raj Bantu has a question. Where is the garage? Is there? It says one car garage. Are you familiar with this floor plan here, Stewie?
I am. It's on the back side of it. So you're looking at the front of the building, technically the front door. Everybody in this community goes in through the garage. That's the way to do it. So the street that's on the other side of this building is where the garage is facing. I don't know if you can go into a Google map view, Pablo, or if we even need to. But if you check it out on Google Maps, you can see the opposite side where the garage is.
Got it. I am not going to fiddle with that right now because I think things tend to break.
You and me both. Absolutely. Yeah, we'll leave it where it's at.
Awesome. Lee Bishop is asking a different question. Is there still a waiting list that JWB has for tenants, for residents? You guys is what we call them over here, right?
No, yeah, not an official waiting list per se, Lee. I mean, we're only working with people that are ready to move within the next 30 days, right? That's kind of the first criteria. If we get less than 50 homes on market, that's when we start to pre-show, right? So if we've got a property turn, if we've got a new build that's coming up, we may list it 2 days early, 3 days early to give people kind of a sneak peek and generate interest that way. But usually that 50 homes on market is kind of our trigger before we go to that situation. So hovering in the 70 range right now, kind of business as usual.
All right. He says he likes that. I like it too, Lee. Drew Barnhill came in with a question right now. Thanks, Drew, for contributing to the show as you always do. What is the ballpark wait time for locking up the property to finishing and closing now? I know I locked mine up in June and now I'm supposed to finish and close in November. Do you have kind of like a ballpark of that?
Yeah, it'll depend on the property, right? As we're putting homes under contracts, everybody, I mean, we're doing it literally, as it's coming out of permitting, which is the biggest hurdle, right? You got to get past the city first and get the thumbs up and the green light that you can build these particular houses. And then from there, we always tell people to anticipate, an additional 60 to 90 days on top of the estimated completion date, just to make sure, we've got wiggle room for supply issues. We've got wiggle room for weather. Holidays will be here soon, and I hear people want to take some time off, right? I'm sure that's going to be the case. So with that, I mean, just to give you an example for this week, Drew, a lot of the houses that we're putting under contract are tentatively slated to finish in March, right? So when I was talking early on, planning your year now, right, is going to be critical. If you get to June and say, hey, I'd like to pick up X number of properties in 2022, half the year's gone. It's going to be a challenge to get there. So we're building them, right, and putting them under contract. It's just a matter of making sure we take that additional chess move, right, to make sure that we're building out our portfolios in a timeline that matches with your guys' specific goals.
So talk me through that. So that's not a wait list. That is, you're able to lock in a property, which one is yours. You're not sitting there waiting to get a call. It's just a matter of wait. Can you kind of like describe to me the difference between that and a wait list?
Yes, very big difference, guys, right? A wait list means I have 0 homes to potentially put under contract right now. I'm literally sitting in a queue, right, and waiting for the next 6 months, 12 months, 18 months, whatever the number is. And then once I get to the top of the queue, right, if I've got 2 properties available that week, it's me and everybody else in the queue vying for those properties. And either you get them or you don't, right? And there's not a lot of time to decide. With us, where we have a steady stream or a pipeline of inventory coming out, right, you have the ability to put it under contract now, right, lock in pricing now, which is huge, because a lot of folks, especially with construction, they're going to build in clauses where they've got the ability to say, hey, if lumber spikes by 200%, right, we can increase the price by X, which we just don't play that game, right? We want to make sure that the price is the price. And if it takes us longer, naturally, we're equally motivated as you guys are to get these finished, completed, and obviously into your portfolio. So big difference between being able to put something under contract now that's being built versus, having to physically wait and then, fight off the masses to try to get your one home.
Yeah, and in this environment, Lee's putting in here in the chat, nice to hear that JWB does lock in a price. Just ask Maryland, right? Like it is, in this heavy appreciation environment, at least you're locking in the price of the construction, of the home that you're going to buy, and you guys are real comfortable delivering on that like that.
Yep.
All right, man. Well, we
Great
don't
question.
have any new questions right now, so let's go into the usual breakdown that we do here. So we got these 2 numbers, right? Like we have learned on these calls that what you're really buying isn't so much this picture as much as these 2 cells right here. And one is total monthly cash flow. The other one is total ROI. What does this total monthly cash flow represent?
Yeah, so when you look at this, it's our responsibility to make sure that we paint really two two pictures, right? Two different ways to look at this. And I tell everybody the total monthly cash flow is designed to give you a baseline expectation as to what a typical month will look like on this property, right? So when we call you and say, hey, we've collected all rent, the residents are in a great place, no maintenance items, do you need anything from us, right? I know how much money is going to be hitting my bank account after all of those fixed expenses, right? So when we talk about fixed expenses, those are the things that are going to happen every single month. These will be your taxes, your insurance, your HOA if it's applicable. If you've got any other ancillary expenses with the property as well, if I'm paying for a water softener or a septic system or a well or whatever it may be, those are coming every month. So we want to factor those in addition to JWB's property management fees, right? Because you're paying us to collect that rent. So understanding what that looks like to give you a realistic expectation as to what a typical month is really the purpose of the first number, which is wonderful, but it has two glaring omissions, right? And the first glaring omission is that we always collect rent, right? Which won't be the case 100% of the time. Somebody will move out of your property at some point. The second thing is that we never have any problems, right? And we know that maintenance is going to be a part of this as well. Even with a brand new construction home, something will happen at some point in time. So when we look at the total return on investment, that's where we factor in everything that we can possibly think of that would affect the overall ROI on this particular property. So when you're talking about maintenance expectations and vacancy expectations, tenant placement fees, right, happening every 4 years. We want to try to paint that picture. So when you're looking at 7.40, that's going to be everything before appreciation, guys. So that's the key difference between those two numbers. Both are equally important, but definitely distinctly separate.
Got it. So $112 a month is my typical monthly experience, right?
Mhm.
Most of the time that is fixed costs minus fixed revenue, right? That normally happens on a monthly level. Total ROI takes into account kind of like the overall journey that you're going to go through when you are investing in this asset. One of the big things that I learned recently is this idea that this, when you're financing, it starts with $112 a month cash flow, but as you pay down the loan and you do all these different things, you're building a portfolio based on this cash purchase total monthly cash flow, because at some point you're going to own the house outright, so your cash flow is going to be $745. So as you're like building this retirement plan, you guys talk people through this idea that in 20 years, 30 years, this is what you're estimating. You want to tell me a little bit about that? Because I haven't talked to one of you guys about that, only Gregg.
Yeah, so when we look at it, we've kind of adopted this whole concept of phases, Pablo. So everybody's going to go through, traditionally 3 phases. The first is, identification and accumulation, right? So how many houses do we need to hit our goals? And then, especially in a growth market like Jacksonville, where every month, every quarter, every year, things seem to be going up in value and working against us, right? We've got to sprint to that particular goal and really focus all of our efforts, our capital, our energy towards getting to that target number of properties. And once we get there, we usually tell people that you just pause and reevaluate, right? Is this, what we had thought would happen, right? Are the other pieces of my financial life in place the way that we thought they would be? And if they all magically are, then wonderful. We're kind of done with the first phase, which is accumulation. Second phase is debt pay down, right? So I think a lot of our folks are utilizing 20 or 25% down. They're typically doing 30-year notes, but I don't think many of our clients have dreams and aspirations to be paying on these things for the next 30 years, right? So then all of those same effort, energy, capital that we're focused on buying houses now goes to getting rid of, the debt service. And once we do that, that leads to the third phase, which is your distribution, right? So we talk about people's whys a lot, and the distribution phase feeds the why. Right. So when we're building out plans for people, you're absolutely right, Pablo, that while you've got the debt in place, $112 a month on this particular property, but when I pay it off in 22 years or 11 years or 30 years, whatever the number ends up being, you're going to be, generating, today's equivalent of $745 at that point in time. So when we look at people's goals, we try to really dial it into what we need to be responsible for here in Jax, and then just look at the averages based on free and clear homes to target the minimum number of properties you're going to need to own to get to your goal.
Got it. Really great explanation. I don't think anybody had broke down these 3 phases on the show today. So we uncovered some gold here with Stewie. That's awesome. Lee Bishop's
Yeah.
got a question. Yeah. Yeah. I like it, man.
Love the gold.
Yeah. Love the gold. Love the gold nuggets. Is there a train whistle for the gold that we just found?
We're prospectors. This is fantastic.
All right, prospecting whistle. All right, man. Lee Bishop asked, does this house have a resident? Do you know if this house has a resident in it already?
This one, I'm not for certain, guys. I'd have to go back and look and see where we're at with that. I think it's still under construction, if memory serves me correct. So you see the little asterisk in the bottom there where it says property currently under construction. I don't think they're done with it yet. I think this is part of a group that's finishing here in the next 2 months. So we'd have to check, Lee, but my guess is probably not yet.
There you go. All right. Leo's got a long question here that I'm going to dive into. All I've read is the end, which I think is kind of funny. Good morning, all. My scenario right now, I signed up the contract for my second JWB property last June 2021. And during that time, the estimated time for the project to be done is end of August. Then it moved to end of November, then early December. And now it moved further back to around middle of February 2022. That's around 8 months. I understand about the construction delay, but is there any way this can be expedited, or what are my options at this point, or just wait at this point? Last week's show, Gregg mentioned about 4 months. Sorry for the long question. On another note, buy crypto. All right, Lee. I know Leo buys crypto and buys a bunch of different alternative investments. We should have a crypto show one of these days. But yeah, do you know anything about that, Mike?
Yeah, Leo, I helped Leo with the onboard. So good to hear from you, my friend. Yeah, with the delays, I mean, candidly, when you run into those, there's a host of things that can happen. You know, like we had talked about with supplies, you do have some ancillary permitting in certain situations. You have utility holds in certain situations. I'm pretty sure with that one, Leo, and I'll go back and look at it. I think we've gotten through the majority of the heavy lifting pain points where we would have kind of an outside influence that we didn't have a lot of leverage on, that would cause us to continue to be delayed even further. So I'm hopeful that the worst is behind us, and we're kind of putting finishing touches on things as we push towards the estimated finish date that we gave you. So you will run into it from time to time. You know, the alternative, right, would be to try to leave that property and go to another one, which wouldn't put you in a better situation financially or time wise. So, I think sitting tight with that is probably going to be your best go at this point.
Awesome. Okay. But his price is locked in?
It is, absolutely. So even though it's taking longer and the home's going up in value, I mean, that equity piece is kind of that silver lining. So I know it can be frustrating, Leo, and really appreciate you being patient, but for sure, there's some benefit there.
Cool. That makes a lot of sense, man. I appreciate the transparency, right? Like we like to, that is not a question that I think people would want to asked on their show, but I love this is what
you
this is
put it
for,
out
right?
there. Yeah. Be real.
Yeah, put it out there, be real, open source community. If you're new here, this is how we do it. Also, if you're new here, let's talk about this total ROI. Talk to me about the 5 profit centers of rental property investing and how they fit into this 7.4% number, please.
Yep. So you've got 3 of the 5 here. When we look at it, traditionally, you have net cash flow, you have principal pay down, tax savings, appreciation, and then the inflationary hedge. I don't think we ever really factor the inflationary hedge. We all know that it's happening, and it's very real. It's why people are buying tangible physical real estate, amongst other things, in this environment. But looking at the 4, right, you're going to have 3 of the 4. So we intentionally leave out the appreciation component, which is kind of weird, right? Because Jacksonville's a growth market, so you'd think we'd have megaphones and be on the mountaintops screaming about appreciation. And it is candidly going to be, especially if you're levered, it's going to be the biggest part of your overall return, right? But it's also the most inconsistent. So when we look at years like last year and this year and even next year, where everything is the little liquid gold nuggets, Pablo, right? And everything's on fire. That's wonderful, but it won't always be that way, right? There's going to be years where it'll be like this. There'll be years where it'll be down. There'll be years where it'll be flat. And that's why when we talk about, holding for a full market cycle, it's no different than, buying Tesla stock and telling me what it's going to do in the next 12 months. Right. And trying to have that crystal ball. It's really, buying something that you believe in, holding it for 10, 15 or 20 years, and allowing you to really, smooth out those ups and downs. So long-winded answer, but when you look here at 7.4, it's going to be everything but appreciation. If you go to the fourth tab again, Pablo, on that analysis conventional, you can actually go in there with the enable editing. It should be 13 or 14, I think. 14. You can plug in 4%. So annualized since the early 90s, I think everybody's heard it here time and time again. We're a little over 4%. So plug in a 4% figure, and it's probably going to throw your total ROI into the low 20s, I'd guess.
Stewart, you're stealing my thunder here, buddy. I was about to do that thing, right? So let's talk about that, right? So we just talked about this idea that you can't really predict the short term. By the way, when you mentioned Tesla stock, I was literally asking if anybody owns Tesla stock in the chat. So,
were you really?
Because it was a really good week for Tesla stock.
It was.
Yeah. I'm just selfishly saying because I own like 3 shares. So all right. So can't predict appreciation in the short term, but when you look at it long term, you can basically know the answers to the test ahead of time. Jacksonville historically has had 4.3% appreciation. Right now it's going bonkers, way over that. But we can safely assume that if you are in it for a long haul, you're going to be able to count for that 4.3% appreciation. So we don't do, like when we do it on the show, we don't always do it here in the conventional financing tab. We do it here in just the appreciation rate, 4.3% appreciation. Pop that in, look at these numbers right now, go from 7% to 23.04%, right? So if you were wanting to put those price appreciation numbers into the total ROI, this is how you do it. JWB doesn't do it because you like to underpromise and overdeliver and only promise the what's controlled inside of the asset. But can you explain to the Not Your Average Investor community here in your own way why this thing went from 7% to 23% when we just plugged in a 4% appreciation?
Yeah, it's all about the power of leverage, right? So when you look at your profit centers, right, whether you call them 4 or 5, right, you always compare it relative to your skin in the game, your total initial investment. So what is my down payment? What are my closing costs? And then I'm going to compare all of the good things that I receive relative to my initial investment. That's why when we look at a levered property, right, if I have the entire asset growing as a whole, I get the benefit of 100% of that appreciation on the home, even though I've only put 25% of my own money in, right? So if I take a large pool of good stuff relative to a smaller initial investment, my ROI is much higher, right? If I do it the other way, if I buy it outright in cash, I've got the same pool of good stuff, just relative to a bigger initial investment, which causes the return to be lower, right? So I tell everybody, typically you're going to be ROI centric or cash flow centric, and oftentimes you'll transition, throughout the life cycle of your plan, right? But it's really, that's where the planning piece becomes even more important, to talk about what we're trying to do and the variety of different ways that we can get there. But when you're talking about putting 20% down even versus 25, guys, I mean, your ROI pushes even higher. Your cash flow is going to get thinner, right? So you have to be mindful of that. But it can be wonderful if your timeline, or your runway per se is longer in that situation.
Yep. So as you said that, I went into that analysis of conventional financing tab. Again, why we recommend that you download this thing to fiddle with it. I put in that 20%, right? The normal assumption here on these tabs are 25% down payment. Put in 20%, and the ROI went up even more to 27.28, and the cash flow went down a little bit, exactly what you just described, Stewie. So I'm going to go step by step on kind of what I did there. So this is at 69, this is 27.28. If I go back here, up here is where this down payment number is. Go back to 25%. We go back to this cash flow that we had already talked about, 112. And then if we go back down to 0% appreciation rate, we go back down to 7.4%. So little, nuts and bolts illustration of the power of leverage, the idea that in rental property investing, it's one of the few asset classes where you make money on not just the money that you put into it, but somebody else's money that you're borrowing and leveraging against it, and the power of that long term. I thought you stated that really well, of you have different priorities, right? Some folks have cash flow priorities, other folks have more long-term ROI priorities. For myself, since I'm thinking about it down the line, I went with 20% down and conventional financing, because the cash flow is not here to change my life right now. The cash flow is going to change my life later down the line. And in the meantime, what I want is that really good ROI. So really well explained, Stewie. All right.
Cool.
Well, we are good here. Unless there's any more questions. If there's any more questions from the community, throw them in there. Stewie, what would you say? Right now is what is the typical question that people are having these days? Like, is there anything that people are showing up and expecting one thing, but it's another? Do you find yourself having any kind of like conversation over and over again that we can address here on the show?
No, I think just having realistic expectations in terms of the numbers and cash flow, right? I mean, as we evolve more into an appreciation focused market, right? As we evolve and price points continue to go up, the narrative is going to change, right? 10 years ago, we could sell you properties that had $250 or $300 a month in cash flow. Today, people are looking for that, and it's just not what our market's about. So I think just really adopting the fact that, when you look at a well-diversified real estate portfolio, you're going to have a portion of that portfolio that's going to be for growth, right? And that's where we fit in. Not only do you get this well-managed, well-oiled machine, right, of 85 wonderful teammates here in the building, but you've got an asset that's going to grow like crazy in the background and take care of itself along the way. So I think just recognizing that for what it is and taking advantage of those opportunities, it'll set us up to build, wonderful pieces of people's portfolios.
Well said, buddy. That's a nice little clip we're going to make for you. I think that should go on your LinkedIn and your Facebook profile. Well delivered. You did. Oh, we got one more. Question for Michael and Joanna. Does JWB have a list of properties which are available to buy? And is that list sent to the JWB family of investors on a daily or weekly basis? Excellent
question, Joanna. And the answer shortly is no. Right. And the reason is because it's so fluid right now. The lists are changing oftentimes daily, right? As homes are going under contract and other ones are being released. So the admin, I mean, I don't have very much hair as it is now. I certainly wouldn't have any left if I was trying to figure out how to do this on a daily basis. So that's thing one. But the other piece is that I think, our very fiber, our culture is more relational, less transactional, right? So if we just had a list and said, here's some houses, let's figure it out after the fact, I think it would be very contrary to how we're kind of hardwired as a team. So if we get to that point where, you've got an existing portfolio and you're looking to add to it, just talk to your portfolio manager. They'll get you in touch with Brandon or myself, and we'll make sure that we get you the updated list and talk through it and find a really wonderful fit. Naturally, if you're new, start the conversation with us early. We'll walk you through the full onboarding process to make sure that we take great care of you as well. Awesome.
Great answer. That also reminds me of this idea that we talk about a lot on the show, and it's that part of your fabric is that since you operate like a hedgehog, right? Like you do the same thing over and over and you do it really, really well. You look at these properties more like widgets than properties, right? Because you have kind of taken away the variability around the real estate long-term investment transaction by being vertically integrated and producing the same asset over and over and over. That may look a little different in the picture, but it looks very similar in the total monthly cash flow and total ROI and the life of the experience. Is that kind of right too?
Absolutely. Yeah. We're chasing that consistency, everybody. That's the key driver that makes this work. And fortunately, we've found a wonderful recipe over the years and are continuing to replicate that.
Awesome, man. We got one more question. We're going to keep it going until we got questions. And,
okay.
And then I got a teaser for next week's show. So you don't want to leave until we get there. But we got our friend from France again. Anonymous Attendee asks, climate change is a topic that comes up more often these days. Some experts are predicting that large parts of coastal Florida will either be completely underwater or be highly prone to flooding within the next 10 to 20 years. Can you talk about that and how insurance can only mitigate some of those concerns? Stu, you want to take a bite out of that? I'm kind of an environmentalist nerd, so I got something to add, but maybe you can talk about how insurance plays into the equation.
Yeah, actually, University of Florida did a really neat study about the rising waters, and I probably, you can correct me if I'm wrong, but I mean it was a crazy crazy low statistic, right? As far as, you know, a 0.11 inches per year or something crazy like that, as far as what it was rising at. I put a lot of faith and trust in, you know, Army Corps of Engineers and their ability to think way farther ahead of that than I do. I also look at the city of New Orleans, which is amazing that it's been underwater for 250 years now or whatever it is. And, you know, it continues to thrive and do wonderful things, even if a hurricane gets it every now and again. So I think as long as we've got that forward thinking, we've got really intelligent engineers that are, you know, proactively tackling these drainage problems, these rising water situations. That's thing one. The other thing is that most of our homes, guys, are probably 15 to 25 miles inland. So if the coast is underwater, it's really not going to impact, you know, the majority of these homes at the end of the day. Certainly not in my lifetime, maybe my kids, right? But, you know, that's a ways down the road.
And listen, Stewie, I think that those are a couple of really good points. I can tell you that I am less optimistic on these studies, but not all parts of Florida are built the same, right? Like I can tell you, Anonymous, that I moved to Jacksonville from Miami because I do believe that there are parts of Florida that are going to be underwater in our lifetime. And it's not going to be like Waterworld. It's not like the ocean shows up and like takes over the city. But there are these like low-hanging parts of Florida that are above a porous aquifer. So there's this like underground river, and that stuff is rising too. And those places are going to flood inland, regardless of, you know, regardless of like what we do on the coast. And there's no solution for that. Luckily, that's not where Jacksonville sits. So like one of the reasons I moved to Jacksonville is because I believe in the longevity of Jacksonville over the next 60 years of my lifetime and being able to buy real estate here. And even more so, I think that the effects of sea level rise that are going to happen, of this like coming down from under the ground, you know, you're going to start feeling that before you know, the actual flooding, right? Like South Florida, the aquifer is going to get salinated. That's going to require major infrastructure investment in South Florida for them to like keep up with that stuff. We're mitigated against a lot of that, right? So, and furthermore, if South Florida becomes unlivable, I think that Jacksonville prices are going to super skyrocket because we don't have that same problem. Like our problem with sea level rise is solvable because it's only going to come from the ocean. It's not going to come from underneath us. Like we know how to live within water in Denmark and in Amsterdam and in New Orleans. We just don't know what happens if it comes from underneath us, like the Thriller video, somebody coming out of the crypt to like haunt your life, right? So I think it's a really valid point by Anonymous Attendee, and I think it's really important to understand that this is something that's going to happen in Tampa, it's going to happen in Miami, it's going to happen south of Lake Okeechobee, and what I think that means for properties in Jacksonville is actually a positive thing, as much as I hate to admit it, because I'm an avid environmentalist, and I think that, you know, we are in for some pain. So like, just my perspective on it as somebody that drinks from a reusable water bottle every single day and drives an environmental car and owns Tesla stock. So, you know, just my 2 cents there. All right, Lee Watt has a question here. What are the 5 areas of benefits? Maybe I think that means what are the 5 profit centers? You want to kind of go into that again, Stewie?
Yeah, absolutely. So net cash flow is the one that everybody focuses on, right? That's how much money is left after I pay all of my expenses on a monthly basis. You want to look at principal pay down if you have a note in place, right? Because each month that your resident is paying rent, they're also paying your mortgage, right? And of your mortgage payment, part's going to go to principal, part's going to go to interest. So the part that goes to principal, we want to count that because that's going into your pocket, whether you realize it or not. Tax savings is just going to be standard depreciation on the property. The IRS allows you to write the building off over a 27.5-year period. You can hyper depreciate it if you want to. It's a totally different topic for another day. And then the 4th profit center is going to be appreciation, right? How much is the city, the area around me, how much is the home going up in value each and every year over that 10, 15, 20-year period?
All right, there you go. Lee, I hope that answered your question there. All right, we're now, like as always happens late in the show. That's why we kept it going. I told you not to leave. We got a bunch more questions. Ken Moline asks, we will be in Jack's first week of December 21. Would like to have a short sit down with Mike. Will you be available? Mike, are you available?
Yeah, just email me, Ken. Let me know when you're coming. We'll figure it out.
Cool. All right. Oscar Chavez has a question. The cash flow is negative in the out years. Please explain if you haven't yet. Thank you. I guess we're gonna have to go into the sheet here again. Give me a second.
We can, and this is a really good thing to bring up, because when we talk about being real, right, and painting the most accurate picture that we can for you, the really cool thing, if you guys haven't seen it yet, is the return on investment tool that we've built out over the years that essentially acts as an extension of this spreadsheet, right? The onus is really on us to try to get this as right as we possibly can. We don't have a crystal ball. There's certain things that we can't predict, but we can use experience, we can use historical data to try to get you as close as possible. So if you look in any year that we have a tenant placement fee, so if you look in row 28, Pablo, you've got that 1224 in year 1. We've got it again in year 5. We've got it again in year 9. The method to the madness there is that people are staying with us a little over 50 months on average. I think we're 54 last year. So what that tells us is that, when we're prepping you guys for the out years or the property turn years, right, that's going to happen every 4 years on average. And when that happens, right, essentially we're operating with 11 months out of 12 in terms of rent, and the expenses don't take a break. Right? Even though that we're only getting that 11 out of 12, everything is continuing. So if you go down to rows 35 and 36, okay, row 35 is going to be your net cash available, essentially when everything is cleared, right? And then the number right below that in 36 is my mortgage. So you can see in year 1, right, we're at 7133, okay, and my mortgage is 7605. So if we do basic greater than or equal to, right, types of math, naturally the income is not higher than the mortgage. So technically we're going to run cash flow negative in the years where we have those tenant placement fees. And that'll hold true for single family or townhomes in this particular case. It's pretty equal opportunity, guys. And that again is assuming that we have average maintenance, is assuming that we have all of the other average expenses as we plan it. You could potentially run cash flow negative in the years where you have tenant placement, and then it rallies, right? In years 2, years 3, years 4, we're in a wonderful place. They move out, we rinse and repeat that process. So we say that not to scare you guys. We say that to be real. We also say that so you can prepare emotionally, prepare financially, and build a portfolio, right? If you have just one property, the magnifying glass is going to be on it, and that experience, that journey, as you like to call it, Pablo, is going to be amplified, right, either to the positive or to the negative. So again, really making sure we set that right expectation is why we factor that in, and we don't veer away from it.
Oscar, you get the award today, man. Number one, this is highlighting the reason why we ask you to download the sheet so you can dive into it. I had never heard the term out years. That's new to me. So I just learned something new after almost 2 years of hosting this show. Lee Watt, is there a way for me to have a copy of your spreadsheet? It's terrific. Heck yeah, Lee. We've posted it in the chat a couple of times here. If you scroll up, but let me see if I can grab it and put it here. But if you are listening to us on the podcast in the near future, if you go to jwbinventory.com, all of our past properties of the weeks are there with this sheet available for each of them. So feel free to grab it. It's an interactive sheet. You can do whatever you want with it. So Oscar, again, out years, I learned something new. Awesome. 2, that's a great dive into the numbers and showing the property of the sheet. Really, really appreciate that, my man. I'm glad you're here.
You bet.
Raj Bantu has a question. How many feet above sea level is Jacksonville? I would assume that that's different places have different feet above sea level. But maybe there's another one that you can't answer is what percentage of JWB properties need flood insurance?
Yeah, I would say probably less than 5%. I will probably typically see, 6 or 7 properties a year where we need flood insurance. And oftentimes that's because the FEMA maps change, right? So as you look in the insurance world, they're constantly reevaluating where the flood zones are, where they aren't. And sometimes, we'll buy an asset, we'll hold it for 2 or 3 years and then build on it, right? And then all of a sudden the asset that we bought 3 years ago wasn't in a flood zone. And now I've got the back third of the property in a flood zone. The one thing that obviously we always commit to you guys is that you'll know it, right? If we know it, you'll know it. And the numbers have to make sense, even if you've got to go out and buy a flood policy for, $400 or $500 a year, right, to make sure that you've got ample protection. So not very often. You'll know if we know, and ultimately the numbers have to work for us to be able to sell it to you guys.
Oh man, we went down a couple subjects we don't normally tackle, man. That was really, really cool today. Great questions from the community. Great one there at the end, Oscar. I'm glad people stuck around for that one because I think it was a great learning lesson. Love the sea level rise discussion because I'm super passionate about it as much as I hate sea level rise. We got to do something about it. And I honestly think that Jacksonville is in a place to, for better or for worse, to actually benefit from it. So I think I'm an early part of that migration. Next week, we got a fellow by the name of Andy Tanner, who is a Rich Dad advisor. And he is an expert, not just in real estate, he's an expert in multiple asset classes. And he's going to be talking about how to get the stock market to cash flow for you, just like a rental property investor would. He's going to give a high level breakdown of the numbers in the economy and how you have to think about that across different asset classes in your portfolio. And he's going to talk about multiple asset classes in the portfolio. We're doing something really cool this week where we are posting these like previews of coming up on the Not Your Average Investor Show. If you see that video on social media, give it a like, give it a share, give it a follow. I'd really, really appreciate it. That's something my team is just starting to put together. I would love your feedback on it. Comment on it, see if it's cool. Like we say, if you want to know about owning rental income properties, you were in the right place today. If you want to learn about property management for rental property investors, we talked about some of that stuff today. You were in the right place. If you want to get an edge on the Jacksonville real estate market, you were in the right place today. We talked a lot about the Jacksonville real estate market. We never take it for granted that you took more than an hour to hang out with us middle of the workday on a Thursday. I don't take it for granted for you, Stewie. I know that you're super busy blowing train whistles of all these awesome deals that you guys are doing, man. Thank you so much for showing up. You really, really brought it. I love being a part of this. Stewie, I'll give you, do you have any last words here to say goodbye and thank you to everybody?
No, I mean, just really appreciate you guys all continuing to turn out week after week. It's really cool to see what this has grown to. And I tell you what, as I'm talking to new people every day on the phones, I'm pushing people to the group and saying, hey, this is JWB clients, not JWB clients, investors, not investors. I mean, just a wonderful mix of people. You'll get people that shoot straight. So really kudos to you and the group that you built.
Thanks, man. And that's a great tag, right? Joanna just put the links to join the group in the chat. If you're listening on the podcast, if you just go to jwbfacebookgroup.com, you can join the group. And if you want to schedule a time to talk to Stewie, go to chatwithjwb.com and you can actually get on this man's calendar and schedule a time. So next step, if you like what you heard, go to chatwithjwb.com. Otherwise, we'll see you on Tuesday with Andy Tanner. This was an awesome show. Have a great rest of your week. Thanks, Stewie. You're the man.
Thanks, everybody.